One analyst from Morgan Stanley thinks that the S&P could drop another 22% and we could see 3,000 points on the S&P 500 by the end of 2023. There's a major concern here, and this analyst believes that investors are too narrowly focused on inflation dropping and rate hikes, that we're not seeing the bigger picture as far as earnings recessions coming up and stocks taking a, or the S&P. I don't want to say stocks, we're going to get in that in a second, but the S&P seeing a major drop due to earnings. One major concern is that investors in Wall Street have too high of expectations, even though they're not great expectations of company earnings. The expectation line is still a little bit too high in comparison to what this analyst thinks they should be, because we have not felt the ramifications of these rate hikes yet. When these companies start producing very bad earnings, it can cause the S&P 500 to drop significantly during this earnings season. But this is the look and the vision of the first part of 2023. The second part is a whole different story. But when the Fed sees that these earnings are horrible and we're just getting terrible earnings reports, and it's clear that we're in a recession, that's when they're going to start cutting back those rate hikes. But by the time that they cut those back, it's already going to be too late. We're already going to be in a recession. We're already going to have horrible earnings. And then in that case, the S&P drops down another 20 whatever odd percent. But there is an opinion that growth stocks like tech stocks, they like Tesla, have already seen their bottom, unless Elon goes and makes a tweet, right? Or something bad happens in Tesla. But stocks like that in tech and high growth have already seen their bottom and may have a chance of outperforming the overall market. I'm gonna pull up this article here. It's from Market Watch. Market consensus currently suggests that U.S. economy will experience a mild recession starting in the first half of 2023, followed by a recovery in the second half as the Federal Reserve is expected to stop its rate hikes and possibly cut rates in response to the worsening economic conditions. However, Morgan Stanley strategists said that the equity risk premium, in other words, ERP, remains way too low given the high earnings risk, while corporate earnings forecasts for 2023 are materially too high. Like I just said, the forecasts for all these earnings are very high. It doesn't make any sense for what we're starting to see, from all the rate hikes, everything we've seen from the Fed. None of the earnings forecasts make any sense. But this is the chart he's talking about, right? This is the ERP chart. You go back to 2008. We saw a major run up in ERP of 700 basis points for a recession. Then that was when the recession was priced on the market. You go back to 2020, was it 2020? Yeah. Another 400 basis points right here priced in. Look right here. This is where we are now. We are just below before where we hiked up 400 basis points in 2020 and pretty close to the 2008, right before the 2008 run up. ERP is extremely low, which indicates that the recession is not exactly priced in the market just yet. So that's one of the reasons why this analyst thinks that the market could drop down to 3,000 points on the S&P 500, because again, even though we've seen this massive sell-off in the market, he doesn't think that the recession is fully priced in the market just yet, and we could see that another 20%, 22% drop. And it's all based around earnings, and earnings recession causing us to sell off even further. But by the time the Fed comes in and cuts rates, it's already going to be too late. We're already going to be in a recession. We're going to have these horrible earnings reports and this massive sell-off. So by the time the Feds cut rates, it's already going to be too late. However, the market is going to recognize that, okay, a recession is priced in and the Fed is going to start to cut rates here pretty soon. And what's going to happen is you're going to see the market rally before that even happens. Because once we see a priced in recession, then it's like, okay, we know it's priced in. We know the recession's here. We know we're in it. The next step is for the Fed to cut rates, and people are going to start rallying and buying into the market. So you're going to see that rally before the Fed rate cuts are even going to happen. But that is just my personal opinion. You know, I'm not a financial advisor. None of this is financial advice. Just my personal opinion and based off what I've seen from Morgan Stanley here and the analysts. If you like this kind of content, be sure to smash the like button down below. Subscribe to the YouTube channel if you haven't already. There's tons of more videos coming out. I have a lot planned for this channel, and I will see you guys in the next video. Cheers.